Meanwhile, we're watching the markets. A 13 lakh crore rupee fall in market cap, and this over the last 5 sessions. The Nifty has gone below 22,000. The volatility index, also known as the fear index, is at a 52-week high. FIIs are selling off, a sell-off of almost 7,000 crore rupees on the 9th of May itself. But really, all is not lost, because if you look at the SIP picture, SIPs have crossed the 20,000 crore rupee mark. And this has happened for the first time ever in the month of April this year. So what are the forces behind market volatility, and what next should we expect is the big question. Let's bring in our guests, our market watchers. Mayuresh Joshi, head of equity at Marketsmithindia, is with us, along with Santosh Rao, the head of research and partner at Manhattan Venture Partners. Glad to have you both with us. Mayuresh, how do we read into the rise in the volatility index and now FIIs selling about 16,000 crore rupees in the cash market month to date, and more than 1 lakh crore rupee if you look at the picture year to date? What are the factors at play here?
I think the basic and the mood factor has been the low voter turnout, which has probably spooked the markets. Again, the perception here is that is the existing government going to come back with the majority that the markets were hoping for? But I think it's too early to call that. I'll just take you to a very interesting data point, Vikram. Back again in 2019, if you look at the first 2 or 3 phases, it was very, very similar in terms of the voter turnout. And what happened is history, right? They won far more seats than 2014. So I'm not a political analyst to determine how many seats they will win, but I think the major reason for the spooking the markets was probably this reason as well. The second element also has to be seen in the context that a few results were not at par. So a lot of heavyweights like L&T, as an example, gave a very weak guidance. What you're probably seeing or expected to see from Asian Paints was also on the weaker and softer side. HDFC Bank, again, in line with expectations, but again, expectations of weak recovery as far as a large bank like HDFC is concerned. And Reliance gave an expected set of numbers. So I think if you look at the heavyweights on the index itself, the results expectations are not at par, which probably is also a reason why there was some element of selling pressure. And last but not the least, the FII selling that you just mentioned, I think they are pulling out over the last few days and weeks as well. But again, the number that you put forth, Vikram, in terms of the domestic inflows, SIPs crossing 20,000 odd crores, if this probably persists as we've seen in the past, I think that should provide decent and ample support as far as liquidity is concerned. So do I look at this as a structural downside to the market? Probably not. It's a shakeout that is probably happening with perceptions that markets is building in. Structural reasons in terms of a bullish outlook for India, both on a macro and a micro scale, still remain intact.
Structurally, the Indian markets are looking strong to Mayuresh, and there are multiple reasons at work for FIIs pulling out. Santosh, do you think there is more to do with an increasing uncertainty about the outcome of the elections that has spooked FIIs, or do you read more into it?
Yeah, thanks for having me. I think that's one of the reasons. We can start off with that. This is normal election year volatility that's expected, but more so this year because the incremental investor or the typical investor might be worried that the Modi government, if they do get elected, which I believe they will, may not be able to continue with their pro-growth policy, business-friendly policies down the road. And that's a big deal for international investors, that India continue on the path that it's on. So I think that's definitely a big factor. The low turnout, I don't know if it translates to low votes for BA NDA, but we don't know that. But that volatility will definitely is enough to shake the market a little bit, to shake the investor a little bit. And the second factor, I think there's definitely a little bit of profit taking that's going on. I mean, the markets have been high for a long time, so that definitely plays into any type of sell-off. So that might play. And the third thing, I think it's very important, the risk reward for in the US has improved a lot. It's much better. So now an investor really has to really think about, do you go along with all the risk associated with the emerging markets, particularly India, when you can get a safe, good investment in US, and especially in the face of the consensus building that we may not have any cuts this year. The talk is shifted from 6 cuts to 1 cut to 2 cuts, and now there is even a consensus building that we may not have any cuts, so the rates will stay high, and the data is supporting that. So I think those are the three factors I would think, overriding factors. There are other smaller factors that play in, but net, I think I would narrow it down to these three factors.
I would even add, perhaps, Santosh, the strength that's returning to the Chinese, to the Hong Kong markets. Is that also a reason? Because you did speak about the global construct. America is not looking bad at all, and I've been looking at the Dow over the last 6 sessions, and we've been on the rise. Tell us how the Chinese and Hong Kong markets also now lending weight to investors. Is that a reason too?
Yeah, so China has always been a very tough market. Still a lot of risks associated with that. It's coming off a very low base. It's sold off quite a bit, so it's picking up definitely. So a risk averse or a risk taker will definitely step into the China market. But I think he or she may want to wait and see how it plays out. If there's a trend developing, definitely that helps. It's there is some money going there as well, improving money. But I wouldn't say it's a trend already. It's just kind of recovering at this point. So that's not a major factor. I think there are other markets that are much better than China.
So in that sense, in terms of valuations, Mayuresh, how does India compare to some of its closest peers, according to you, that would tilt an FII's choice of destination to park money today?
So again, valuations from an Indian standpoint, Vikram, are not too expensive and they're not too cheap. So I think we'll have to admit with the run-up that we've probably seen that Indian markets are at fair valuations. Now, if one assumes the kind of earnings growth estimates or forecasts that a lot of analysts on the streets are pegging in for FY25 and FY26, the earnings growth is largely in the range of 12 to 14% for FY25 and around 11 to 12% for FY26. So you're expected to see an earnings CAGR of almost 12% over the next 2 years as far as the Indian markets are concerned. Now, if I peg that in terms of how the index shapes up in terms of the EPS estimates, it turns out to be around 1,050 for FY25 and around 1,150 for FY26, which means it trades around 20 odd times FY26 numbers. At the peak of the 2008 bull run that we'd probably seen, we had touched almost 22, 23 odd times. And the base case median becomes 16 to 17 odd times. So we are right there in the middle as we speak, close to middle as we speak. And the premium case for India has been, as I said, the structural story, both macros and micros. GST collections are holding up. Tax collections have been robust. Expectations in terms of their fiscal path over the next 3 years would probably be on track. And therefore, I think the macro story, which includes corporate earnings, expectations of consumption returning back with normalized monsoons, rural coming back very strongly, capex continuing from the government side should lend support. So in my opinion, I think that a tad bit of premium valuation gets justified for India compared to the rest of the emerging pack.
Do you agree with that, Santosh? The kind of valuation picture that Mayuresh is painting when you talk about the Indian markets compared to peers?
Yeah, I think the Indian markets are expensive. It's well established, but they also know that that's where the growth is happening. It's the fastest growing economy in the world. So I think they command a premium, so which is understandable. And that's why money is still flowing in, even though albeit kind of slow in the last few weeks. But definitely, and US market, just I'm talking about that, US right now is like 20 to 21 times the S&P 500 earnings forward 12 months. That's expensive. And it's been driven by a very narrow band of tech investors, tech companies. There are 4 or 5 companies that are really driving that. So on a equal weighted S&P, it's kind of less, but we need to pull back a little bit to make it more healthy. It's at a record level. And that's going to happen. It's going to broaden. It's going to lesser. Non-tech stocks are going to pick up here as well. But net valuations have run up. There was markets were flush with liquidity. Money was flowing in. There was the free for all. Money was free to an extent. Very low interest rates. So all that I think is coming home to roost. As things get more expensive, valuations will come down. And that's the bet. And that's what Fed wants. And that's good. If for the rates to come down, for inflation to come down, we need the temperature to come down. And that's what's hopefully that will happen. India, I'm sure it will show up pretty soon if it has not already. US, we are seeing signs of that coming in already, where things are cooling down a little bit.
They are cooling down a little bit as far as the US is concerned, but on the valuations in the Indian markets, you seem quite assured that it is expensive, while Mayuresh believes we are fairly valued at this point. But sectorally, Mayuresh, you'd have to concede the most susceptible packs have been banking and IT. Do you sense why these two are facing a lack of confidence when it comes to FIIs? Because that's where the biggest pullouts are happening. Is it the regulations by the RBI, you think? Is it the kind of earnings growth outlook by the tech majors? What do you put it down to?
So for IT in particular, Vikram, I think, and what Santosh had pointed out, I think the recovery has been very strong for the US markets and the European markets as well. But the expectations in terms of a rate cut delay will probably mean that the three biggest sectors that the IT sectors look for, BFSI, retail, and manufacturing, I think those three sectors are still going to see some element of lag in terms of order activity. And if that lag extends from a quarter to 2 quarters to 3 quarters, that will have an impact as far as dollar revenue growth is concerned. Margins have largely stabilized for a lot of top tier and mid tier IT companies. But if the top line growth probably does not come through in the proportion that the markets are expecting, the bottom line growth will also be equally muted. So to that extent, I think a delayed recovery in all these three key segments in geographies within the domains that the IT sector works out might push out earnings in the second half of the calendar year. For banks in particular, for India, Vikram, I think the biggest issue for large private banks has been deposit growth. So I think that's where the mood problem probably lies. They have cleaned up the balance sheet quite significantly, both private and public. But I think deposit growth still remains a huge concern. When that improvement will probably happen is when the rate cut cycle will start taking place. So I think, again, third quarter of this financial year is where the expectations are that a reasonable amount of deposit growth should start picking up. And again, a case in point being that the smaller payments bank, as an example, have shown very weak set of numbers. If the rural recovery gets delayed for some reason, I think the lower tier banks might still get affected in terms of collection efficiency, so on and so forth. So being a little bit selective within the banking pack, but I think it should recover well post the third quarter of this year.
How that recovery pans out as and when it happens, but if this kind of sustained selling by FIIs does take place at a pace of 5,000 to 6,000 crore rupees every day, it really needs to be seen whether the defensives are going to step into the spotlight and whether the domestic investors are going to fill the gap, because we are talking about how SIPs have been growing in recent times and that momentum continues. Mayuresh Joshi, Santosh Rao, thank you very much for joining us with your perspective on this edition of India Tonight. Pleasure having you with us. And
if you like this video, then like, share and subscribe to ET Now.